You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Superior, Colorado. Welcome to the show, Rick.
Thanks for inviting me on, Jim.
I was taking a look at the equity boards today. They're all in the red. The only things that were going up today were Costco, McDonald's, Pepsi, and car part manufacturers. Are those the only good things happening on the stock market right now?
Yeah, go figure. You know, I always see the glass as half empty or perhaps half full of hemlock, but of the group you just named, the car parts thing, that could be an interesting development. You know, there have been stories out over the last few days that delinquencies are rising on car loans, and we've got kind of an aging fleet, so we're coming off a huge record year for car sales. But I think this car parts rally is based on the assumption on one day's news that people are going to be keeping their cars for longer.
Well, it makes sense. They've taken out 8 and 9 year car loans, so you're going to have to keep that car longer to pay off the loan.
Well, thank heaven for the Japanese. You know, I in the 60s, I had a BMW, kind of first generation for that car in this country, and it needed a major overhaul every 4,000 miles. And when I bought a Honda, it was as though I'd gone to heaven. You know, all I had to do was put a little water in the battery every 50,000 miles, and it ran just fine.
Well, Mitsubishi's standard warranty is 10 years.
Yeah, that's pretty amazing, and I'm amazed. You know, I have a Lexus now, an old SUV, and I mean old, and it asks for nothing. It just keeps going, and it's still pretty tight.
Of course, I remember when American cars were built to fall apart after 2 years, so you'd have to buy a new one.
Yeah, and in some places like Japan, I guess they make you buy a new one. You can't be driving around with any dings in your fender.
Well, that's a good way to keep things going. Also in Japan, it's mandatory to have rear view mirrors on the fenders of your car so you don't have blind spots. And we used to have that here, but I've noticed they don't make them that way anymore.
Well, they're getting there electronically, though. You know, the newer cars have sensors. I guess it's some form of radar that tells you when there's a car in your blind spot. It actually warns you if you try to pull into that lane.
Some makes will even take the wheel out of your hand to keep you from hitting it.
Not sure. I haven't figured out these I'm trying in my mind to imagine how cars will drive themselves, and for all the tens of millions of miles that Google has racked up in California with accident-free test driving, whenever they have one fender bender like they did a week or so ago, a car and a bus collided, I think, the whole week they got to start from scratch.
But if they've had one accident out of thousands of miles, take a look at our rush hour reports every day. Accidents all over the place.
Yeah, and the traffic is getting so dense. You know, I think a lot of it falls into federal guidelines that are attempting to compress all new construction in California. The idea is that if we're all living in anthills, so to speak, we won't have to commute. But even in a place like Boulder, you can see that it's impacted traffic. You get one fender bender on the main route between Boulder and Denver, and as it occurred last Friday, it backs up for 2 miles.
Or in Vancouver, one accident 20 miles away will back you up. It's so congested here.
Right. It's at the margin that we have these traffic jams, and I think that's what throws the planners off. They don't seem to understand that the traffic that's flowing well today would absolutely choke if you put 50 more cars per hour on it.
Well, I hear some urban planners already are saying when we get the robot cars, that's going to change our parking habits, so the car will drop you off at work and then it'll go home or someplace where it doesn't have to pay to park. and then come pick you up when work is over. And that could create its own kind of traffic jam.
And it's a terrible problem for car thieves, too.
Well, yes, I'm sure it'll probably be voice activated, so if it's not your voice, the car's not going to work.
Right. It's hard to, it's definitely going to play havoc with the car theft business.
Well, I feel very sorry for them. Rick, moving on to other things, I was also watching some business news today where they say grain prices may pick up this year simply because El Nino follows El Nino, and that means bad weather and a shortage for grains.
Well, I think that whenever you hear those stories, or let's say whenever the phenomenon itself percolates up to the level of news, you can pretty much forget it. It's already priced in the commodities themselves, and my guess is they've got nowhere to go but down from here.
Oil, copper, gold, silver all went down today, and usually gold and silver are counter to what's happening in the equity markets. Why has everybody decided to take the elevator down?
I think actually they still are running counter, but not in lockstep. So what happens is if you had a huge market rally in the broad averages, the Indus, the S&Ps, they'd be hitting gold harder than they have today. You know, gold's been down as much as, well, let's call it $20 today. That's basis the COMEX April contract. But I think, gold would be down another $20 if stocks were strong. But I think that part of the weakness in gold is based on the fact that even if stocks aren't strong today, the bears aren't exactly putting shares away. You know, the Indus were down at one point a little more than looks like 100 points, but currently off 30, and it just looks like a stalemate today. So on that basis, you know, I would say gold has kind of continued the trend of the last couple of days.
People ask me, what's a better pick right now, gold or silver?
I like treasuries. I have a subscriber base that's really enthused about gold, and sometimes I have to bring them bad news. I've had a long-standing bear market target down around 815, but as a practical matter, I ignore the long-term forecast when the short-term perks up, and I put out each day what I call the daily freebie. It's usually one of my actionable trading, what I call touts. But today's headline was, just a little bit of selling in gold brings out the doubters in force. But as I point out in that technical analysis, gold would have to come down a further $80 from where it's trading now before it even retraces 0.618 of the nice rally we had from mid-February.
Well, that's good news, and gold, since the start of the year, has made a huge rise, hasn't it?
Yeah, it's looked really good, and who knows why. I just kind of look at the technical side of it and don't try to get into the 10,000 reasons why it's going up. But I will say that there's a very crucial number for me in gold at 1308, and that corresponds to a price peak that was made in January of last year, and I referred to that peak as the Matterhorn. If gold were to get above it, I would say we'd have a reasonably good chance that the bear market begun in 2011 is over.
Bullion or gold stocks?
Well, the miners, these juniors, have been pounded down so hard, and I've gone on a few junkets to see some of these mining operations. And I have to tell you that some of them are they're pretty impressive, and they're run by people who know what they're doing. And the stocks, meanwhile, are hugely undervalued. You know, if gold turns around, or it even looks like it's turning, you get tremendous leverage in these junior mining stocks. On the other hand, I think if you go into it with the idea that they've been sold to death, they can't go any lower, that's a dangerous assumption because, even though they've been pounded, there's still lower lows that are possible.
Right now, when you buy gold, you get a gold certificate. How many more gold certificates are there compared to the actual physical product?
Well, it's quite the ratio is something that could really get a bull's juices flowing. And in theory, all of that paper gold represents a lot of it anyway, represents a short position against gold. You know, everybody's trading paper the same way they're trading dollars that have X amount of backing. So to the extent that there's not physical gold to correspond to all of the paper, if at some point the holders of paper said, well, I want to take real gold, in other words, in effect, take delivery on the gold, there'd be a real squeeze on the price of gold. And I think the squeeze could reach such extremes that the regulators would have to step in. And the problem with the $5,000 or $10,000 an ounce theory of gold, that there's some people out there, gurus, who say that that's where gold is going. Although it's possible in theory to get there by way of a short squeeze on physical supply, in reality, you'd need for the regulators to say, hey, look what's happening here. We are going to hold all the bullion bankers' feet to the fire, meaning Goldman Sachs, Morgan Stanley, all the short side players in gold, and we're going to make them deliver gold to the little guys. And if you can see that happening, you understand how, well, it takes a bit of an imagination.
The Canadian government sold off the last of its gold reserves the other week. Was that a good move on the part of the Canadian government?
Well, it's usually taken as a contrary sign, sort of like a Time magazine cover story. And of course, Britain was one of the early sellers of gold, and they are notoriously bad for timing. And since Canada is ostensibly a part of the Commonwealth, you could say they're making the same mistake. But we should want to see Western sovereign entities sell off their gold if we're bullish on it, because we know that on the demand side there's plenty of buyers, namely China, Russia. They look to gold as a store of value, even if it's become valueless to the Western banks.
I remember a few years ago, maybe even just last year, people were calling gold pet rocks. Do they still have that same attitude now?
That's about it. I think that's one of the multiple choice questions on the central bank job application is, which one of these best describes gold, and pet rock is the choice that they all select.
A lot of countries, like Germany, Japan, Hong Kong has it as well. They have little vending machines that will sell you little wafers of gold, say for €100 or $100. Could we see those machines here, or is the security risk just too high?
That is really cool. I think you'd have Gresham's Law at work there. There was a time, it's very hard to believe that there was a time in America when someone would slap a St. Gordon's $20 gold piece on a bar to pay for drinks. It's too precious really to use for transactions. And I think gold would have, I can't see gold circulating, although you think back to a time when in the U.S. it did, and you'd have to imagine, gee, what kind of civilization were we, or what kind of nation were we in any case, when we were able to plunk gold down on the bar to pay for drinks. And in a way, it kind of sums up the times. The values were very different then, and we were almost literally living in El Dorado. So I don't know. I wouldn't want to be putting gold vending machines out there because they'd have to be solider than ATMs to withstand the onslaught of crime.
We'll have more with Rick Ackerman right after the break.
Bird Dog, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Rick Ackerman. Rick, oil prices over the long term, what do they look like?
recent rally that we had seems to have failed. I thought it would get at least to $40 basis the NYMEX April contract. Got to 39.05, so it missed by $1. And it also, this nice rally we had in crude, missed getting above a previous peak on the April chart at 40.50. So that looks like a failed rally to me. And if the downtrend that has begun from the recent top at 39.05 gets a little momentum, I could see it coming back down to as low as 27 and change.
Now, of course, at least in the Vancouver area, they don't hesitate to put up gasoline prices when the price of oil goes up. But I notice they're very slow to reduce prices when the price of oil goes down.
Yeah, very sticky coming down, but, just get a report out there that that crude oil inventories have gone down by 10,000 barrels, and you'll see price of gas shoot up by a nickel. It's amazing. And you can almost trade the commodity, gas or crude, based on you go to the pump and you think $2 a gallon, this can't last. And if you just go on that instinct alone, you could have made some money.
Well, of course, in Vancouver, that would translate to 50 cents a liter. And right now we're almost paying $1.20 a liter. Vancouver, for people who don't know though, also has the highest gasoline taxes in North America. So the tax man walks away, laughing as well as the refineries. And we also haven't had our annual springtime West Coast refinery fire or explosion, which is always the reason they give for higher prices on the West Coast than anywhere else in North America.
I've always wondered about that, when they talk about, we've got West Coast gas prices up 35 cents a gallon because we've got a major refinery closed for maintenance. And I'm thinking, why don't the oil firms close them all for maintenance? Just leave one facility open and they'll get, the price of gasoline to double overnight. We didn't have that kind of supply-demand reasoning when we were little. Gas prices fluctuated only a little bit, but these days, when you see the price go up 20 to 30 cents a gallon over the course of just a few weeks, it's nothing unusual.
And it's not like there's a worldwide shortage of gasoline. In Europe, they're turning away tankers full of gasoline.
Right. And that corresponds to things you read about natural gas. My energy utility company here they were every winter raising the gas bill, so that it really got pretty. Well, they were up in nosebleed territory, and then when the price of natural gas came down, there was no corresponding decrease in my heating bill in the winter months. And in the old days, there'd be newspapers that went out and got to the bottom of that, but these days, the only stories we read in newspapers are ones that smack reporters in the face, like a snowstorm.
And also, natural gas prices are so low, U.S. natural gas pipeline has declared bankruptcy.
Yeah, it's a tough industry. I spoke with a friend of mine, old college buddy, who acquires rights of way to build pipelines and such, and he says work has been scarce. He said that there are companies that would hire him, but they don't have any active projects going, so he's kind of sitting it out. And of course, we just read another story that contradicts something. When fracking came on stream and we had huge supplies of gas, and then the price started to go down, you read analysis that said, well, these companies are very nimble. They're not big, ocean-bound drilling rig companies. They can sort of start and stop their operations relatively easily, and so that relatively small changes in the supply-demand picture could either take out capacity in the fracking business or add to it. But it turns out that the fall in natural gas prices has put so many drillers in such bad financial shape that they really can't ramp up right away. They're basically trying to survive from a financial standpoint, and they're hardly thinking about getting all their rigs going again.
I've heard in Alberta the rig count is 75 active rigs, 200 just sitting there in the stockyard.
Yeah, and that's a lot of idle capital. And we're still not out of the woods. There's so much energy-based collateral that the banks are holding right now because the last collapse was based on housing collateral. This time, the leverage artist used a different form of collateral, mainly energy, so that, it's small wonder that the stock market rallies when oil prices rally, because when we see that happen, the higher energy prices are, in effect, bailing out the banks.
What kind of shape are the banks going to be in when the oil companies can't pay their loans?
Well, I think they're dead meat, really. Energy collateral adds up to a very, very large number, and it's a little bit housing crisis in that you've got so many bits and pieces that are leveraged to the hilt. Every single stream of payment, every form of capital has been hawked 50 times over. So, it's the same situation where a relatively small failure within the energy business could be catastrophic for the banking system as a whole.
Is that why banks are so keen to charge you extra fees? I mean, in effect, we have negative interest rates in North America already because of high service fees.
Well, they're really desperate for revenues. The banks have laid off a lot of workers in the last couple of years, and some of a lot of banking activity and bank profits were based on activities that were essentially forms of leveraging. And we're in a deflationary deleveraging phase right now, and it's really hard to make money. All the money is made when things are leveraged out, not when they're contracting. And in these deflationary periods, you're doing well, whether you're a bank or a household even, just to hang on to something like your peak net worth.
Is China's move to snap up all the North American real estate they can the same as it was for the Japanese back in the 1980s?
The Japanese were literally buying everything. Pebble Beach, they were paying $60 million for Impressionist paintings, and Rockefeller Center, and they're buying everything in sight. The Chinese, I think, they're still looking for value, and maybe the fact that they're into U.S. hotel chains so late in the economic cycle and the alleged recovery cycle suggests maybe they're running out of top shelf investments.
Well, I've heard a lot of Chinese investors don't care if the real estate bubble bursts and they lose 20%. They still have 80% of the money they put into it. They fear the Chinese government will seize everything to prop up its economy.
The 20% thing is that's a fallacy that I've dealt with in my own life. I had a seat on the Pacific Stock Exchange, and one of my best buddies bought a couple of them when they were selling for next to nothing, like $10,000 or $20,000. And I used to say, look, sell one, take your money out of one, because what have you got to lose? Because at that time they were $500,000 bid and not much in the way of offers. So he had given up trading because he could lease each one of the seats for 2.5% a month. So he was collecting. All he had to do for $300,000 annual income was open 2 envelopes a month and cash the checks. And so he said, I said, just sell one of the seats, no one ever went broke taking a profit. And he said, well, look, if these seats were to go down 20 or 30%, I would still be way ahead. and what he did not foresee, what actually happened, was the seats went from 500,000 down to around, 6,000. So it's not a question of I could take a 20% hit here. When you go into these really inflated markets, you might be looking at a 94% hit.
Rick, was there anything else you wanted to talk about today?
Oh, we have some discussion in the chat room, my chat room, Rick's Picks, about how if this or that happens with the election, with the campaign, that the stock market's going to take a header. But I don't think we're going to see Wall Street even care remotely about the election until after it's happened. It's a very interesting campaign for sure, but we've seen Wall Street shrug off some things that were ostensibly more threatening than whoever winds up in the White House. So I don't think the election year, I don't think politics is going to have much effect on the market, but the day after the election in November, we may wake up with a collective hangover, and there will be an effect.
Rick, thanks a lot for chatting with us.
Always a pleasure, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Questions or comments for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.